Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. In this video, we're going to talk about the Buffett and Munger approach on how to invest. First off, we should understand the business. That's the most important thing. The second approach is about durable competitive advantage. It's a factor that gives a company an advantage over its competitors. The third is the management of integrity and talent. And lastly, the fourth approach is to ensure a margin of safety. These four approaches are very simple and easy to remember, and those approaches never change. So we have to spread these ideas to everyone new to investing. Unfortunately, now in 2022, we are dealing with some challenging new issues in our investments. We got highly inflated stock markets, high inflation, and the possibility of interest rate hikes this year as a result of that inflation. So there are many things to consider because of the inflation. Anyways, let's first talk about those three investing challenges this year. First is the overvalued stock markets. It's hard to invest now, especially since things became more expensive. Here's what Buffett wrote in his annual letter to shareholders in 2019. In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. Prospects for that, however, are not good. Prices are sky high for business possessing decent long-term prospects. In the previous year or two, Buffett has had difficulty finding a suitable investment. Buffett, on the other hand, instead of burning his money on expensive stocks, which is a cardinal sin of investing, you shall not buy overvalued stocks, he just kept accumulating wealth and is waiting patiently. Berkshire Hathaway's cash has grown from $84.4 billion in the third quarter of 2016 to $149.2 billion in the third quarter of 2021. So it's not ideal, but keep in mind that you make money while you wait rather than when you buy or sell. Wait for the right moment and resist the urge to buy average investments in an overvalued market. This is what Warren Buffett has to say. You only need a few great stocks in your lifetime. He also stated that 3 wonderful firms are more than enough to ensure success in our lifetime. There's no need to have a large number of investments, so wait until the market presents you with one. The second investing tip that was typically recommended by none other than Warren Buffett to all individuals is all about passive investing. You may have heard this from our previous videos, but let me discuss it again. Passive investing is a strategy that maximizes the returns but minimizes the buying and selling. Passive investors should continue to invest this year.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
For passive investors, it's all about attempting to invest at the right time. It's not about trying to buy at the correct times. The dollar cost averaging method requires you to invest over time. So simply acquire market tracking investments at regular intervals. If you do it for decades, you'll receive the market's average return, which is currently between 8% and 10%. Here's a short clip of what Warren Buffett said.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Buffett has been telling passive investors that they don't need to worry about the market moving up or down. Just keep going. Don't worry about the headlines or statistics. You need to simply stick to your strategy, and the stock market will become your closest buddy. Even if you invested everything and the market fell 50% tomorrow, long-term passive investors would still be okay, because it only took 5.5 years to recover the GFC, which was the world's biggest financial crisis since the Great Depression. It has almost tripled in value after 9 years on the market. The market is at an all-time high right now. Hey, but it doesn't mean it's the end of the world. That's why I'm sharing these 2022 investing tips in hopes that it might help you out. On the other hand, active investors should exercise patience and refrain from making impulsive decisions, while those who are passive investors should keep investing as they have in the past. Continue to aim for that average. And the second challenge this year is inflation. It's been a big story for the previous 12 months. So we're at 6.8 annual inflation in the United States. And this year looks like it'll be a big year.
It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what?
The next question is, what is the best thing to do? Well, let's go back to 1982 when US inflation was just beginning to fall after reaching over 20%. And Buffett stated in his annual letter to shareholders exactly what kinds of businesses we should be buying during inflationary periods, saying, quote, "Such favored businesses must have two characteristics. One is an ability to increase prices rather easily even when product demand is flat and capacity is not fully utilized without fear of significant loss of either market share or unit volume. And two, an ability to accommodate larger dollar volume in business, often produce more by inflation than real growth with only minor additional investment of capital." From that, he's talking about companies that can raise prices without fear of the consequences. But what will be the company that could considerably raise prices without losing market share? People will undoubtedly look for cheaper goods wherever they can, although not if you have a competitive advantage or moat. People don't switch to other products when Apple raises its prices above the competition. People don't shift to other drinks when Coca-Cola raises its prices. And ironically, they're two of Warren Buffett's biggest investments right now. During the inflationary phase, the most crucial thing to do is ensure that the companies you're looking for have a competitive advantage. Customers continue to buy those products despite the price increase. Buffett also stated that we should seek out businesses that can handle a substantial increase in revenue with only a minor increase in capital investment. Or to simply explain this, there are businesses that can earn a lot of money without spending a lot of money. To raise ad revenue, Facebook, for example, doesn't need to build a new app. They can simply raise the frequency of their commercials, whereas Ford has to build more factories or recruit more staff in order to create more cars, which is considerably more difficult. Hence, in times of inflation, search for companies with a competitive advantage, as well as organizations that are robust and scalable. The third challenge in investing is interest rate hikes. Buffett discussed interest rates during a shareholder meeting in May 2021.
Interest rates, basically are to the value of assets what gravity is to matter, essentially. And on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and it says average price 100.0 0, 0, 0, 0, 0, 0. 6 zeros. The Treasury received the money at 0. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity, its pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much different. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough right now, nothing.
So never let the macroeconomic environment affect your own decisions or choices in investing. It's important to keep in mind that if new bonds become more appealing and interest rates rise in 2022 or 2023 and beyond, prices, particularly for overpriced stocks, may come under pressure. Be aware that it may happen in the coming years, so be ready for it. And there you have it. That concludes Warren Buffett's tips on investing, which should perhaps help us in addressing the investment concerns of 2022. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.